Insurance money is typically very patient, long-term money, uh, and you don't have to chase NAV on a daily basis like some of your mutual fund counterparts have to. How's the patient money looking at the markets right now? Are you looking for correction and waiting patiently, or did you really bought the fall in March, April time horizon?
Hi, good afternoon, everyone. Irrespective of which money you manage, daily NAV or a longer term NAV, the idea to invest in the market should always be medium to long term. That's the mantra that we try and follow. So when the markets fell in March and April, we did buy a lot of stock. But typically our funds do not take cash calls. So even at that time, we would be 95 to 97% invested. And so will be the case here, even today. Coming on your question about the market view that we have right now. Of course, we have seen that the markets have rallied quite smartly. But if you look at the irony of the markets, in March and April, in March per se, FI sold $8 billion of Indian equity. And month to date, till now, they have bought more than $6 billion of Indian equities, which is highest ever in any month. What that tells us is this is money which keeps chasing at different points of time in different markets all across the world. But people make money when they invest and sit tight. So if you invest when the markets are falling and maybe the whole institutional world is selling, and you go into the markets at that time, you will likely make more money over a longer period of time doing that. But what are the markets telling us right now? What we believe is currently it's been a big liquidity fuel rally, which has happened not just in India, but you can see across the world. But in India, a few things which have happened have gone unnoticed. Those things are, for the first time in India in the last 20, 30 quarters, the consensus earnings have seen an upgrade. That too to the tune of 5 to 7%. Some of corporate India, which is the listed and organized space, has taken away a lot of share from the unorganized. What demonetization and GST could not do has been done by COVID-19, which is that there has been a shift from unorganized to organized. That shift has happened simply because the unorganized market was unable to manage their supply chain. They were unable to supply their goods in the market. That has meant that most of the dealers have shifted to the organized players. This shift is more likely permanent in nature because the dealers have understood the viability of staying with an organized player. Secondly, if you look at the cash flow matrices of corporate India this quarter itself, there has been a huge improvement in working capital. One of the main reasons again has been that corporates have stopped or they have avoided or restrained from giving a lot of goods on credit. And what has that done is improve their working capital cycles. Thirdly, the biggest beat came on the EBITDA margins itself. If you look at the EBITDA of, say, Nifty companies that grew by high single digits this quarter, whereas the expectations for the quarter were flat earnings on the EBITDA side. That has been possible because of obvious cost cuts on travel, advertisement, and to some extent employee expenditure. But if you look at it in detail, if 20 to 40% of this expenditure remains with the corporate India, then over a longer term, you're looking at 3 to 5% earnings grade upgrade on a sustainable basis. That's because corporate India has understood that there are some of the costs which they thought were fixed in nature, but they are actually variable in nature. Just to illustrate a few examples, if you look at the consumer sector, advertisement, promotion, and other expenditure can vary anywhere between 15 to 25% of top line for consumer companies. Now, this expenditure has been down by 20 to 50% for most companies, giving a huge EBITDA margin delta. Some of it will come back, but if 30% or 20% of it stays with the corporates, you're looking at a 5% EBITDA upgrade. Travel cost is 2% of revenue for IT companies, ballpark. When you speak to IT companies, they tell us that even though travel cost will come back, it will never go back to the same levels, but maybe at 50 to 60% of pre-COVID levels. So even in this pandemic, we believe corporate India has done a fantastic job of trying to nurture costs in a way which are more sustainable.
Right.
Now we are waiting for the economy to come back. Once that comes back, and the flow through can happen to the earnings. Still.
Right. Right. Okay, Rohit, on that front, I want to understand that the street has started to build in earnings recovery for the second half of this year, plus sharp recovery next year and a bit ahead. And some of them, I would caveat that the bullish ones are not rolling out a 20% CAGR for 3 years ahead. What's your own take? Do you see that kind of a horizon also conceivable?
Yeah, okay. The thing about consensus earnings is if you start every year, they build 20% earnings growth. But for the last 5 years, it hasn't been the case. It's for the first time that this quarter that consensus earnings saw an upgrade. So that in itself is a start. That does not mean that we are projecting a 20% earnings CAGR for the next 3 years. Simply because the situation right now is very, very fluid. It is very difficult for me and you or anyone to tell how the second or third wave COVID situation will pan out in the US, in Europe, or for that matter in India. So a lot of those earnings are predicated upon what we see currently sitting here in October and November. What we can say for sure is that things are looking up, where corporate India has tightened its cost structure. Now you need top line to come. For top line or revenue to come, you need GDP to come back to growth. What we are seeing is this year GDP is likely to degrow close to double digits. And in FY22, most people are expecting the same kind of recovery in GDP. So you're saying that FY22 GDP will be almost the same as FY20 GDP, give or take a little bit here and there. If that happens, in my opinion, FY22 EPS will be higher than FY20 EPS simply because corporate India has learned to cut costs in a more sustainable way. Talking about 3 to 5 years, obviously the story for India always looks bright. More so now, simply because we have seen in the last 3 to 9 months or a year, a lot of specific moves either from the government of India or from the corporates to be more self-reliant. We have seen what has happened with the mobile PLI scheme, which has been a huge success, where domestic as well as overseas manufacturers have vied for it. And it is a game changer in terms of mobile manufacturing. The other PLI schemes and the Atmanirbhar schemes are here to stay for a long term. And the EBITDA margin expansion, which I talked about, which can give a 5% Philips on a longer term basis, can mean, if not 20%, but high teens kind of earning CAGR is possible for the next 3 years as well. Of course, with the caveat that we do not get another COVID-like situation or any other situation which can be a black swan event. If any of that were to happen, obviously those kind of earnings will be very, very difficult to achieve.
Right. Right. Very quickly, what are your take on mid caps? Do you see value there? High quality mid caps are worth looking into. Are you doing the same in your portfolios?
Well, yes. Our mantra for investing in mid caps has always been to focus on companies which are leaders in their space, but the segment is not a huge one, but a promising one. And those companies which are very stable and good cash flow matrices. So if you look at the numbers for the last 2 or 3 quarters, even during this pandemic, some of the mid-cap companies that we own and we believe are likely to do well have demonstrated great measures of control on cash flow and have actually also gained a lot of market share. These companies, we believe, have a great future going ahead. They will garner market share from some of the smaller companies within that space. And given their balance sheet strength, they are likely to be winners. And they are likely to see a higher growth potential than even the large caps. So we have added some mid caps in the last 3 to 6 months, continue to hold them because we believe that some of the mid cap stories that we are into are likely to see better growth and cash flow profile going ahead.
Right. Right. All right, Rohit. We'll let you go on that one. Thanks so much for joining us on the show today. I look forward to having more of you on the channel going forward. Let's take a short break on that note. More news and analysis will follow on the other side of the break. Don't go anywhere.